Hi, I'm Sue Meitner, and if you earn money from freelancing, consulting, driving, selling online, or running a digital business, you might be wondering, will my side hustle help me qualify for a mortgage or hurt me? So let's talk about the new mortgage reality in 2026, because modern income doesn't always fit into the traditional lending box. The new mortgage reality is here, and here's what's happening. The gig economy has exploded. Multiple income streams are now the norm, but lending guidelines, they're still built around predictable W-2 income paychecks. Banks love consistency. They love stable salaries. They love numbers that repeat every month. What makes sense in the real world is fluctuating deposits, seasonal spikes, digital payments. That doesn't always translate into understanding mortgage math. Here's the trap I see all the time. Someone earns great gross income from a side hustle, but after expenses on their tax returns, their usable income is much lower. High revenue doesn't automatically mean high qualifying income. That's different, and it can affect your mortgage approval. Debt to income ratios still rule because the mortgage approval still comes down to one core metric, debt to income ratios, or DTI. This compares your monthly debt to your usable gross monthly income. Most loan programs want your total DTI to be somewhere between 43 and 50% depending on the program. If your tax returns show a lower net income because of your deductions, your DTI increases. If you have a side hustle, documentation is everything. First, separate your business and personal bank accounts. When deposits are mixed together, it creates confusion for the underwriters. A clean paper trail makes a smoother approval. Second, understand seasoning. If you suddenly deposit a large amount of money, lenders must verify it's not borrowed funds. Large, irregular deposits that aren't documented can delay or derail a file. Typically, funds need to be in your account long enough to be considered seasoned. They must be sourced properly, and you need to keep accurate bookkeeping. Many lenders now require a current profit and loss statement, especially if they're in a new calendar year and your latest tax returns aren't available yet. Using automated bookkeeping tools can help you generate a monthly profit and loss statement that shows stable income trends. That's powerful documentation. In most cases, to use a side hustle income for qualification, lenders want to see a 2-year history, filed tax returns, stability or growth, not your income going downward. So here's where you can estimate your mortgage ready income. Take the net income from your last 2 years of tax returns, add them together, and divide by 24 months. That average typically is what we can use. If income is declining over the years, we may have to use the lower number. If it's stable or increasing, that's a good sign, but we still need to use a 2-year average. So not every lender handles non-traditional income well. Some institutions rely heavily on automated systems. Others, especially those experienced with self-employed borrowers, are comfortable with manual underwriting and a deeper income analysis. If you have multiple income streams, working with a gig-friendly lender who understands tax returns is critical. This is not a one-size-fits-all approval. When you're ready to move forward, here's what happens. We need to verify your 2-year income history. Then we confirm your current year earnings that are matching or exceeding what is on your tax returns. If you're mid-year and the income is trending lower, that can affect your qualifying. If it's trending higher, that can strengthen your file. Finally, once you're under contract on a property, that's when you can lock your interest rate, because rate locks are tied to specific homes and closing timelines. So the lending world It is adapting, but underwriting is still built on stability, documentation, and math. Your job is to create consistency on the paperwork. My job is to translate your modern income into mortgage approval language. If buying your first home is on the radar, especially if you have a side hustle, the smartest move is planning early, because you want to do this with your tax year so that you can directly see what will affect you and you'll be able to qualify for next year. I'm Sue Meitner with another Mortgage 101 video. If this was helpful, subscribe, like, comment, and if you need an answer about buying your first home, feel free to call me for clarity, confidence, and a strategy.